Hello and welcome. Thank you for tuning in to today's webinar on regulatory compliance updates for financial institutions. My name is Jamie Terrell. I lead marketing and communications here at Saltmarsh and will be your moderator for today. We're happy to have you here with us and are excited to be bringing you more industry-specific webinars in the months ahead, covering everything from compliance issues like fraud, fair lending, CRA, to developments in tech and cybersecurity, corporate governance, strategic management, the list goes on. As you may or may not know, Saltmarsh has an interdisciplinary team who focuses entirely on servicing community banks, and we look forward to bringing their expertise to you and using these webinars to share the latest. If interested, you can sign up for email updates as new programs are offered. And of course, you can always find webinar recaps, upcoming events, and related information on our blog and website, saltmarshcpa.com. You see that showing here on your screen. Leading today's presentation, we have Sarah Oliver. Sarah is a senior manager in our financial institution advisory practice. She focuses on providing compliance reviews, facilitating special research, and consulting on various regulations and marketing approaches for our firm's financial institution clients. Prior to joining Saltmarsh, Sarah worked in community banking herself, working for small and large banks, so she's really tuned into the challenges that this industry is facing today. She also produces a great recap of regulatory compliance changes each quarter. We mail those out by email to our clients and friends in the industry, much of what she'll dive into today, actually. So we have attached a copy here as a handout for you. You can find those handouts in your GoToWebinar menu. I believe they're under handouts. If you have any trouble finding them, though, let me know. If you're not already signed up to receive these or want to make sure someone else on your team is getting them as well, you can subscribe now using the link that you see shown to receive them by email as they come out. So before we begin, just a few quick housekeeping notes I'd like to mention. First, everyone is muted for privacy. If you have questions, you're welcome to share them with me using the questions feature in your GoToWebinar controls. I'm not positive that we'll have time to take questions, but send them over regardless. We're happy to get back to you. You're also welcome to email your questions to the bank advisors at saltmarshcpa.com, and someone from our team will follow up with you that way. Our webinar is being recorded, and you'll receive it tomorrow by email along with a copy of our slide deck. And finally, upon leaving today, you'll be prompted to complete a very short survey. So please take just a moment to share with us on your way out. We would love to know what you think of today's webinar. And we'd also like to know if you're interested in regular compliance webinars, just like this one, in the future. So let us know. If you need anything, I'll be back here in the background. At this time, I'm going to go ahead and invite Sarah to get us started. Sarah?
Thank you, Jamie. Good morning, everybody. For those of you who know me personally, it is no surprise that I am actually excited to be speaking regulatory compliance with you this morning. It does take a special kind, and I found that we tend to stick together. But for those of you that I don't know yet, or who are new to Saltmarsh, welcome. May you feel at home. And like Jamie said, prior to joining the firm, I have worked for both small and large institutions, so I really do understand what it is like on the other side and really being in the trenches. Given our limited time, like Jamie mentioned, I don't think we're going to have time for questions at the end. We have a pretty packed session, but if you want to get in, and also, we're not going to be getting too far into the weeds. This is really kind of a high-level overview, and I'm going to go over some regulatory changes that, if nothing else, I want to make sure are on your radars. If you want to get more into the weeds, again, repeating Jamie, make sure that you stay apprised of our other periodic training and roundtable offerings through our website and our email listing. So with that said, I want to switch over to the agenda. And before we look at the agenda, I want to mention that the CFPB probably not much of a surprise to most of us by this point, is widely expected to assume a posture of aggressive enforcement here in the coming years of consumer protection laws. In February, the current acting director, David Uggio, indicated he personally was assessing regulatory actions taken by the previous leadership and is going to and has been making adjustments as necessary to those that are not aligned with the Bureau's mission of consumer protection. Also, interesting fact, in March, the CFPB began aggressively recruiting for attorneys from other federal agencies to work in its Office of Enforcement. So for those of you who were here for the CFPB's most early years, you may remember the slogan, "A cop on the beat," and I think that that's going to be pretty fitting for them again as we go into, we finish this year and go into 2022. So this morning we're going to spend a little bit of time on the universal or the uniform residential loan application. We'll spend a little time talking about the annual threshold updates, and then we will talk about the new HPML escrow exemption. We're going to spend more time talking about some changes going on to regulations for the Fair Debt Collection Practices Act, which I will be referring to as FDCPA. We will look at the changes to the QM definition and the new category of QMs, followed by a discussion on Libor transition, this OCC's CRA, and then what we can expect in the very near future having to do with ECOA's collection of business lending data. Although I'm not going to be able to talk about suggestions for responding to each of these topics we're going over, I have included on each slide my own personal suggestion for responding or preparing for these regulatory changes. So let's dive in. Okay, so the GSEs have redesigned the Uniform Residential Loan Application, also known as lovingly Form 1003 in the industry, and they did this to help lenders better capture the relevant loan application information and to support the industry's move to digitize the loan origination process. The mandatory date of March 1st has passed. So we should be using this loan application today, the new loan application, although the GSEs did announce that loans started in legacy formats prior to March 1st, but not yet submitted by that date, can continue to be submitted through the end of this month. And the end of this month is right around the corner. So the GSEs have said that any applications on the legacy format that are submitted to Desktop Underwriter after the end of the month are going to be returned with either an out of scope or an error message. So make sure that you have all of your applications submitted by then, and that going forward you are using the new redesigned URLA. And what would a year be without a slew of new regulatory dollar thresholds for the purposes of CRA and TILA, including under the CARD Act? A notable difference this year, and this applies to banks only because credit unions are not subject to CRA, is that while the FDIC and the Federal Reserve share the same regulatory thresholds for CRA, the OCC has gone its separate way, and we are going to discuss, as per the agenda, the OCC CRA in a later slide. But for purposes of the Federal Reserve and the FDIC banks, small banks in 2021 would be those with total assets of under 1.322 billion as of the end of either of the prior 2 years, 2019 or 2020. And then intermediate small banks would be banks under that threshold, but with total assets of equal to or more than 330 million. Some miscellaneous regulatory thresholds. The TILA application, and this is for consumer purpose loans that are not secured by a dwelling. The threshold for that TILA application stayed the same at $58,300, which is the same as it was in 2020. Same thing with the exemption for required appraisals on HPMLs. That also stayed the same at $27,200. The new HMDA asset size exemption threshold did increase to $48 million. And we are going to talk about the threshold for the small creditor for purposes of the exemption to establish escrow accounts for first lien HPMLs on the next slide. And we'll be able to compare that to the new HPML escrow exemption. For the CARD Act, the CFPB annual thresholds saw no change to the minimum interest charge that would require disclosure. So that stayed at $1, as did the penalty fees, the safe harbor for penalty fees for the first and subsequent violations, respectively. Those stayed at $29 and $40. And we know that there's a whole lot more thresholds that change annually. I'm not going to spend any more time on those, especially for HOEPA, ATR, and QM thresholds, but know that they are always included on our regulatory updates for the most current year. And I'm referring to the documents that are actually attached to this presentation. And also you will always find there live links to the Federal Register citations. So let's talk about now the HPML escrow exemptions. So it's important to note that the change to the regulation is actually creating an entirely new exemption. It is not replacing anything. So what we have had in the past, and we still have, and it remains unchanged, is the small creditor exemption. And this is for financial institutions with assets of less than or equal to $2.23 billion, institutions that have originated less than or equal to 2,000 loans secured by your first lien principal dwelling during the preceding calendar year, and has made at least one covered transaction in a designated rural or underserved area, and then does not already establish escrows outside of the HPML requirements. So if you're subject to that exception or exemption, I'm sure that you've been using it for the past several years. New section under Regulation Z, 1026.35 B2 little Roman numeral 6 exempts from the current HPML escrow requirement any loans made and secured by a first lien on the principal dwelling of a consumer if your institution has assets, dollar assets of equal to or under $10 billion. And this is going to be another one of those thresholds adjusted annually, but for this year it starts at 10 billion. And your institution and its affiliates have not originated more than 1,000 covered loans during the preceding calendar year. Also during the preceding calendar year, as with the small creditor exemption, you extended a covered transaction that is located in a rural or underserved area, and then you don't already maintain an escrow account for consumer credit other than those that you originally established for the HPML rule in the first place. So know that that is now available. And here we are talking about FDCPA. Before I get into this slide, let's review a little bit. One of the primary functions of the CFPB is collecting, investigating, and responding to consumer complaints. And I read the 2020 Consumer Response Annual Report detailing complaints by the CFPB and received by the CFPB. And I have to say I was a little disheartened to see that the report listed Florida as the #1 state for number of complaints per capita. And Florida was followed by Washington, D.C. and Georgia. Just a little bit of trivia. Debt collection was the #2 most complained about financial product, and this was up 10% from 2019, so that's a pretty steep increase, topped only by the category of credit reporting, which in many ways ties directly into the debt collection process. The top type of Fair Debt Collection Practices Act or FDCPA complaint was reported as an attempt to collect debts not owed. So, not surprisingly, we have seen our final rules following the FDCPA proposal, and I don't know how old it was. I almost want to say it was back in 2018 when that one came out. But the CFPB issued 2 final rules having to do with the FDCPA. The first final rule was published in November of 2020, and it completely overhauls and expands big time Regulation F or 12 CFR Part 1006. Importantly, the rule excludes first-party debt collectors who are not otherwise covered, but the reason why we are spending so much time on this, I know a lot of you are probably included in that category as only first-party debt collectors. The final rule does not clarify whether certain actions taken by a first-party debt collector would constitute an unfair, deceptive, or abusive act in practice. And I know that a lot of our clients and a lot of bankers that I talked to in the past, their litmus test has been to follow the rules set forth in the prior regulations. And again, it has just been so greatly expanded. So the November rule does several things. It clarifies restrictions on the time and places a debt collector can communicate with a consumer. For purposes of determining the timing of an electronic communication, it has been determined that the communication occurs when the debt collector sends it and not when the consumer receives or views it. And this is a huge win for the industry. It seems fairly common sense that we do not have that type of control over when somebody actually opens their email or their text message, but it was something that was discussed in detail in the proposal. So that's definitely a positive for us. The final rule also clarifies that a consumer can restrict the media a debt collector communicates by and designate a particular one or more mediums, such as email or telephone calls, as the methods that debt collectors may or may not communicate with them. The rule clarifies a debt collector is presumed to violate the FDCPA's prohibition on repeated or continuous calls if it places a call to a person more than 7 times within a 7-day period, or within 7 days after engaging in a telephone conversation with the person. The rule clarifies that newer technologies, and this is positive, such as emails and text messages, may be used in debt collection with certain limitations, and in the case of emails and text messages, provides that a debt collector may obtain a safe harbor for an unintentional third-party disclosure if measures that are detailed in the regulation are followed, such as having the reasonable procedures, or the email or telephone number used to text was used by the consumer in the first place to communicate with the debt collector. Prior consent is obtained and the consumer has not opted out of such communications, and other various distinctions. The rule also clarifies that an attempt through any medium to communicate, even if not successful, is counted as an attempt. And so this kind of, comes into the UDAPI realm. Calling and hanging up before the call is connected, or say the call does not get answered, that is still very much so counted as an attempt. So if we did that 3 times in a row, I think that would raise some eyebrows. Not that any of you would be doing that. And then finally, this rule addresses other topics not limited to, but for example, the definition and acquisition of location information, false, deceptive, or misleading representations, disclosures required in initial and subsequent communications with the consumer, not including a new term, limited content messages, and then ceasing collection efforts on disputed amounts with certain caveats. Following the November 2020 rule, the second final rule was published just in January that clarifies the information a debt collector must provide to a consumer at the outset of debt collection communications. This rule addresses passive collections, which is the practice of furnishing information about a debt to a consumer reporting agency before communicating with the consumer about the debt. And this rule also addresses the collection of debt that is beyond the statute of limitations, and that debt is commonly referred to in the industry as time-barred debt. So for passive communications, except for the furnishing of information about check writing history, the debt collector must first speak to the consumer about the debt in person or by telephone, or mail or send an electronic message to the consumer about the debt, and wait a reasonable period of time to receive a notice of undeliverability. The reasonable period of time is established as 14 consecutive days, and that would provide a safe harbor. The rule also provides a safe harbor for compliance with written communication for debt collectors using the newly established model debt validation notice. Additionally, the rule interprets the definition of consumer under the FDCPA to include deceased natural persons, so that if a debt collector knows or should know the consumer is deceased, it must then provide that same information to a person authorized to act on behalf of the deceased consumer's estate. Regarding time-barred debt, the final rule prohibits a debt collector from bringing or threatening to bring a legal action against a consumer to collect that debt. And it's notable, this is different from the proposal, which had originally included a clause only if the debt collector knew or should have known that the debt was time barred. Instead, the final rule has established a strict liability standard. It does not apply to proofs of claim filed in connection with the bankruptcy proceeding, but it is no longer knows or should know. You must be absolutely sure that this debt is not time barred. On the bright side, though, the Bureau is not finalizing their proposed time barred debt disclosure requirements, although the rule does clarify that any information to time-barred debt that would be specifically required by applicable law, which is a term not defined in the rule, could be included on the model validation notice without losing safe harbor. As far as when both of these rules become effective, the date as it stands today is November 30th of this year. However, there is a proposal out there to extend the date to January 29th of next year to provide stakeholders affected by the pandemic additional time to review and implement these rules. Okay, let's move on to the general QM definition rule. In preparation for the expiration of the temporary GSE QM loans, commonly known to us as the GSE patch, the CFPB has amended Regulation Z by replacing the general QM loan definition's debt to income limit with a limit based on loan pricing and some other changes. The final rule holds that only the revised general QM loan definition would be available for applications received on or after July 1st of 2021, which would render the current general QM and patch QM definitions irrelevant. However, there is a proposal that is out, and I will talk about that here in just another minute or so. Under this rule, the loan meets the revised general QM loan definition only if the APR exceeds the average prime offer rate for a comparable transaction by less than 2.25 percentage points as of the date that the interest rate is set. The rule does provide higher thresholds for loans with smaller dollar amounts, certain manufactured housing loans, and for subordinate lien transactions. The final rule also requires that the creditor consider and verify income or assets other than the value of the dwelling securing the loan, and consider the consumer's debt-to-income ratio or other residual income. It provides a safe harbor for compliance with the verification requirements if a creditor complies with the verification standards in certain manuals that are actually listed in the new rule. Under the March proposal that I was just talking about, the CFPB in March issued this proposal. The temporary GSE, or the patch QM, and the current general QM loan definition, the one that we have all kind of, I think, gotten used to over the past several years, would now not expire until the earlier of October 1st, 2022, or if the GSEs exit federal conservatorship. The good news is the proposal's not making any changes to the new revised QM loan definition, which as of March 1st is also available. So basically right now you are free to use the general loan QM definition that we've been using, the revised one, or the patch QM. What is super important though for some of you, in January, the GSEs preferred stock purchase agreements, referred to as PSPAs, that they have with the Department of Treasury regarding Fannie Mae and Freddie Mac were amended. So pursuant to the amendments, as of July 1st of this year, Fannie and Freddie can only purchase new general QM loans using the new general QM definition. So this is a little bit of a conundrum now. On April 8th, Fannie issued lender letter 2021-09, and Freddie issued bulletin 2021-13 to provide for the purchase of new general QM loans and not the 43% debt to income ratio or GSE patch QM loans for applications received after July 1st. So as a practical matter, many lenders may no longer be originating the 43% debt to income ratio or GSE patch QM loans for applications received after July 1st, especially if they are selling on the secondary market. Okay, still talking about QMs. In December, the CFPB published a final rule establishing an entirely new type or category of QMs. This seasoned QM rule differs from the original proposal in a positive way by adding a new exception to the portfolio requirements that allow loans to be transferred once during the seasoning period, excluding high-cost mortgage loans. To be considered seasoned, the covered transaction must have no more than 2 delinquencies of 30 days or more, and no delinquencies of 60 days or more at the end of the seasoning period, with a couple of exceptions. There's always these exceptions. Creditors can generally accept deficient payments within a payment tolerance of $50 on up to 3 occasions during the seasoning period without triggering a delinquency for purposes of the rule. Failure to make contractual payments does not qualify the loan from eligibility if the consumer is in a temporary payment accommodation extended in connection with a disaster or, as you probably saw this coming, a pandemic-related national emergency if certain conditions are met. However, the time spent in such a temporary accommodation will not count toward the 36-month seasoning period, and so the seasoning period can only resume after the temporary accommodation and any delinquency is cured with additional restrictions. All right, moving on. Libor, as we know, Libor is expected to retire after December of this year. So the CFPB issued a proposal, and this proposal was issued a ways back, and it addressed 4 substantial issues for open-end credit. First, it proposes to permit creditors for HELOCs and card issuers to transition existing accounts that use Libor to a replacement index on or after March 15th of 2021. And it's kind of irrelevant because we still don't have a final rule, and that date has already passed. But basically, I think the intent here was to allow creditors to transition to Libor before it becomes unavailable. Second, related to open-end credit, this proposal proposed to determine that prime and certain spread adjusted indices based on the secured overnight financing rate, or SOFR, as recommended by the Alternative Reference Rates Committee, have historical fluctuations that are substantially similar to those of certain Libor indices. So there the CFPB kind of gives a nod to replacing Libor with SOFR as an option. The final rule clarifies that after October 1st of this year, for HELOCs and credit cards, a creditor is going to have, or would, if finalized, have to provide a change in terms notice disclosing the replacement index for Libor and any adjusted margin, even if the margin is reduced. And then lastly, related to open-end credit, it proposes to add an exemption from the rate re-evaluation provisions applicable to credit card accounts, even if the new index and margin results in a rate increase. So that is very positive if it were to be finalized. The proposal addressed one substantial issue for closed-end credit, which was to add an illustrative example to identify the SOFR base spread adjusted replacement indices, again, as an example of a comparable index for the Libor that they are intended to replace. Now, the proposal was that the final rule would take effect on March 15th of this year. We don't have that final rule, except for the updated change in term disclosure requirements for HELOCs and credit cards. And if finalized, that could still apply as of October 1st of this year. In addition to the proposed rule, there are a couple of interagency statements, and I have referenced those in this slide. And then the CFPB also issued a set of FAQs to address Libor transition topics and regulatory questions. And I would, anybody involved in this transition, highly recommend that you review those documents as well as the proposal here. Okay, so remember the annual CRA thresholds for the FDIC and the Federal Reserve. When I mentioned that the OCC went in a separate direction, here is what we are looking at. The OCC's June 2020 final rule raised the asset threshold for small and intermediate banks to respectively 600 million and 2.5 billion. This rule completely overhauls the OCC's CRA regulatory framework, including provisions for enhanced data collection, recording and reporting. So the rule clarifies that the activities that qualify for CRA credit, including a non-exhaustive list of qualifying activities, which is to be updated annually. And it also sets forth the process for banks to confirm qualifying activities with the OCC. The rule preserves facility-based assessment areas, but also requires institutions to delineate deposit-based assessment areas where they have significant concentrations of retail domestic deposits, and this is recognizing the evolution of internet banking. The rule establishes an evaluation method that assesses a bank's retail lending and community development, or CD, activities by considering the distribution of the retail lending activities relative to LMI populations and census tracts in assessment areas, and the impact of all CRA activity measured in dollars. And here the rule also provides for consideration of the qualitative aspects of CRA activities by including an assessment of a bank's performance context using the factors that we have in the current or previous regulation, and on additional input from examiners. So that seems rather subjective, so we will have to wait and see what that looks like. The rule also provides for a more, according to the OCC, more transparent, consistent, and timely CRA-related data collections. Know that banks of all sizes are going to be subject to enhanced data collection and record keeping, as well as reporting, but there are exceptions to that reporting aspect for small banks. Banks subject to today's general, wholesale, or limited purpose performance standards must comply with the new framework by January 1st of 2023. Banks subject to the small and intermediate performance standards must comply with the new framework by January 1st of 2024. Between now and 2023 and 2024 compliance dates, the provisions of the current CRA regulation will remain in effect, but the OCC has indicated it can permit a bank to voluntarily comply in whole or in part with the new framework as a compliance option. In January, the OCC released a bulletin publishing for year 2021. The list that identifies a bank's CRA type based on asset size or business model, the list of the distressed and underserved areas where certain bank activities are eligible to receive consideration, and the banking industry median hourly compensation value for determining the dollar value of community development service activities. A December 2020 proposal, still in proposal form, requests comment on an approach to determine the CRA evaluation measure benchmarks, retail lending distribution test thresholds, and CD minimums under the general performance standards. The proposal further explains how the OCC would assess significant declines, which is proposed as 10% or more, in CRA activity levels in connection with the performance context following the initial establishment of the benchmarks, thresholds, and minimums. And the proposal indicates that such financial institutions could risk having assigned ratings adversely impacted. Section 1071 of the Dodd-Frank Act instructed the CFPB to establish rules to require financial institutions to collect, report, and make public certain information concerning applications made by women-owned, minority-owned, and small businesses. This was to specifically include 12 mandatory data points plus any discretionary data points. And the mandatory data points will include items such as the loan type and purpose, the amount applied for versus the amount approved, and then the race, sex, and ethnicity of the applicant's principal owners. So we have not yet seen a proposal. However, I did want to include this because the CFPB took a major step towards the issuance of the related regulations in December by releasing a 400-page report of the Small Business Review Panel that discusses the proposals the Bureau is considering. And I say 400 pages, but I have to say, surprisingly, it was fairly easy reading. So don't let that deter you from looking at this report. A positive but not a concrete takeaway is that the report states the Bureau is considering that financial institutions would have a full 2 calendar years for implementation following published rules. It also gives some insight into discretionary data points under consideration, such as pricing, the time in business, and the number of employees. And then there is much discussion there on what should encompass the definitions of women-owned, minority-owned, and application. And I know that the application definition will make some of us cringe because it's just what we need is another definition of application under the ABCs, or I should say ABZs in regulatory compliance. Okay, I'm looking at the time, and these were things that I was hoping I might be able to get to. I do not have time because I want to be respectful of your time. These are items that may or may not affect you or your institutions, but I have given you citations for you to use for further research or to study on the reference topics. And yeah, I am sorry that we're running out of time here. So with that, I'm going to switch over here, and I would remind you all that for additional training opportunities, make sure that you've joined our email lists and sign up for these user groups on this site, LOS, BSA user groups, and then also on these particular sites on this slide, you will have the PDFs of our regulatory change issuances for the last 2 or 3 quarters are always available there. My information is on the last slide, and I truly do encourage you to reach out to me if you have any questions or any follow-up. I enjoy compliance, for those of you who know. And with that, I'm going to turn this over to Jamie.
Thank you, Sarah. Always enjoy listening to you talk compliance, that's for sure. And I'm no compliance, I would say, guru like all of you are, but thanks for pulling the slide back up. I did want to close by letting this group know if you're in the area around the villages, we're doing a live training. It will be very safe to attend. We're taking a lot of precautions, but we've heard from those that we work with that they're really craving more education around some of these topics. And, you know, I think we all kind of want to get to see each other where we can. So we're definitely taking precautions and hope that you can join us for our fundamentals of lending compliance training. That's next week. We still do have registration up on our website. So if you'd like to join us, there's information there. They'll be really digging into a lot of these topics a little more in depth for you there. Thank you, Sarah, for being our subject matter expert for today. I've had a couple of people ask me in the chat, will the slides and materials from today be available? Yes, we will send those to you by email. Should be tomorrow, if not today. So be on the lookout for those. If you don't happen to receive them, you're welcome to reach out to me. You should have my email with the webinar connection details or that bank advisor's email that we mentioned earlier. So again, want to thank you all for being here with us. Hope you gained some new insight, of course, and hope to see you again soon. So let's let you go about your day, and thanks again. Thanks to you, Sarah, and hope to see you all next time.
Thank you.